So welcome, Perennial Pride listeners. I'm really excited about this episode and guest. I have a friend and my estate attorney, Rick Randall, here with us today to share his wisdom around estate planning. Not a topic that most people talk about on a daily basis, but in my world, it's something that I'm growing to appreciate and see the importance of and value. And really wanted to bring Rick on here to share his wisdom and hopefully enlighten folks about estate planning and what that can mean for you. We think about values. I saw this survey through value graphics that said the number one value that people have in their lives that drives their decisions and the things they do is family. And nothing sort of talks more about that, about estate planning than estate planning and planning for your eventual departure from this earth. So really pleasure, Rick, to have you on as a guest. Appreciate your time. So welcome.
Thank you. Appreciate you having me.
That's wonderful. So Rick, briefly just share a little bit about your background. We met years ago. I still remember it at a Prosperity Economics Movement conference. And you're one of the first people I met. I was kind of really green into the industry. I'm still growing and learning in this space. But you were so gracious to spend a little time and just chat with me. And I always remember that initial meeting.
Me too.
Tell our listeners about yourself and your background.
I had actually, Tom, had a financial background to start with, and that's somewhat telling on how we ended up getting together years later. So during law school, actually was licensed, and I had a partner who did most of the work, and I had some of the connections at the law school. And so we did a lot of insurance work with young attorneys as the clients. And when I got to the last year of school, I actually made the decision to go into insurance, and I started with Northwestern Mutual and branched out to Mass Mutual because they had a broker dealer I wanted to expand to be able to offer more things. And so they had an ability for us to actually do a full spectrum, I thought. And then pretty quickly, I ended up thinking I had to be independent and formed a financial planning firm. And out of that financial planning firm, we began recommending living trusts. Mm-hmm. And that was very, very early. And so we had trouble, like most advisors did back then, finding advisors, attorneys actually, who could write living trusts or would write living trusts. So either they wouldn't or they couldn't. And so I got dragged in to become a dual licensed practitioner. So I opened a law practice just to serve my clients, but I was on a financial planning board. The ethical arrangements required me to have a separate office. So I sent out a change of address. I figured if I was going to pay for this little office, I'd sit down there and sent out my change of address announcement and put attorney at law on it. And I got 17 calls the first week from advisors saying, now that you've left your firm, which I had not, would you do trusts with our clients? And that's what kicked it off. And so about 3 months later, I was completely on the legal side. And what I found real quickly, Tom, was that lawyers are very transactional. And it was very uncomfortable for me as an advisor like yourself that we get to know our clients well. And we stay in touch with our clients and try to follow them. And so we created a strategy for estate planning called the 3-step strategy to design a plan. And then what was unusual, maintain it by updating the documents and making sure the finances are still in order. And because you did those two things, the implementation upon disability or death is a lot better because things are in better order. And that process I call Lifespan got licensed. And I'm part of a group called the National Network of Estate Planning Attorneys. I started teaching for that group and then ended up being an employee and then the administrative head and eventually a partner and now the owner. So it's member-owned and member-driven. And all of our members follow this 3-step strategy. So everyone new that is recruited on that and is looking for the lifetime relationship. So that's where I spend all my time. The Prosperity Economics Movement was great for me too. Our mutual mentor, Kim Butler, we got dragged into doing things around the country by her. And Tom, everybody was one of the first that jumped in that I could do online planning. And it's easier than it sounds because you have to meet state requirements all around the country. Even for a lawyer, it's hard to do. And so we got dragged kind of kicking and screaming into that. We now have clients, I think it's 22 states that follow this 3-step strategy. So we try to refer to national network members if there's not one, then, or sometimes preference of the client or the advisor. We work with them through my private firm. So that's me.
That's great. No, it's amazing, and just like anyone else too, with the way it work, the way the world has evolved, like doing things virtually across the country is now becoming more normal, and it's great to be a partner with folks like you. Yeah, and estate planning was never, just like a lot of people, it's one of those things that I don't know if the latest stat was, I'm thinking it's less than half having even a will in place, let alone a more comprehensive estate plan. And it's more curious to me what you see, like what stops most people from even going down this path to get something in place.
Yeah, I think there's a number of reasons, but I think the last stat I saw, by the way, Tom, was 70% don't have, either 69 or 70% do not have any kind of plan at all. And so there's a group that don't have a lot of assets. So that's one chunk that there's not a lot in their mind that they need to protect or to handle. That said, you still have steps that you have to go to, and it's very uncomfortable if you don't do preparation in advance, because the big reason people don't do it is that they don't want to focus on and think about and talk about death and dying. And that's not going to change. And it's similar in the life insurance field, that it's hard to get people to sit down. They know they should. I think there's nothing that I do or nothing that you do that people don't know they ought to do. And, we'll do it someday. And it just, for a lot of people, someday never comes and they run out of time. I think those are the biggest things. And so when you begin to build a larger estate, I think one of the things is it's a hassle, because you own a lot of different things and you have to do a big project to pull everything together. And I think that also stops people who are well-intended and actually really want to do something. And then they find out it's a lot more work, because essentially, whether you use a will or a trust, you have to do work to prepare for what your successors are going to handle. And so those successors generally have no idea. And, we talked a little in preparation. One of the big things during lifetime to do is to spend a little time to get people prepared on what you're doing and why you're doing it and what their role might be. And it's really difficult to do that in a transactional setting. So you've got a problem on the professional side, that it's in and out by the attorneys and the typical advisor views the attorney as a necessary evil. So anyone will do, just get the documents in place. But that doesn't really accomplish anything to have the document, because you own all these things and you have to go to the financial institutions to change names. You have to collect insurance. You have to handle the retirement plans. And so they're woefully unprepared. So one of the things we like about our system is to do some training as a trustee. Typically, we do use trust. And so people like their family to be in charge. And so we try to train them a little bit in advance, so it's not in this huge grieving period where no good information gets in. And more recently, and much better, we've begun to do family meetings as a part of the front end of the planning. So when you go and do a design, you get the documents, that's great, and then off we go to coordinate the assets, and that takes some time. That's a slow and tedious process. And so that would be it, and all of a sudden it's been a year and a half, and the original client's coming back. And so we tell them they ought to get with their family, and that wasn't happening well. So we just added a meeting as we started the transfer of assets. And this family meeting catches up the family members on what their role might be. And almost all obviously would be beneficiaries. And this will sound odd, but you actually need to know how to be a good beneficiary too. No one ever talks about that. And I find people are a little bit more in, well, what do you mean by that? So I might spend a little time to talk about when I'm receiving something, as opposed to having to do work and visualize my parents being gone and things like that. So I think that's the biggest thing, Tom, is just the barrier of even talking about death. And within most families, not a good topic. Most individuals, not a great topic. You add them together and there's just a lot of avoidance. And once you get started, if you're serious about it, it's a lot of work. And so to make one work. And so of that 30% or so, if the studies are right, that have plans, a large number of those aren't going to work because they're just pieces of paper that don't control anything. And I don't think the clients know that.
Well, I remember the first time I got a living trust in place, and none of the assets were basically aligned to it. So it was basically an empty sort of vault.
The empty box,
Basically useless. And, never really this is well before we met. And so even stuff like that's probably happening all over the place, even though you may feel like you have your plan in place. And yeah, it is work, right? And just like anything in life, whether it's in your work, your business, relationships with your family, it takes work to make it effective. Doing things for your family. It's maybe with that, I always think of that sort of phrase where it's if you do the easy things now, life will be harder down the road. If you do the hard stuff now, life will be easier, right? Which one you're going to take? All right, and you gotta decide how important it is. And it is amazing, especially in the this just as well as I do, Rick, around the difficulty for people talking about finances, right? And certainly wealth transfer. I ran across somebody the other day, and their parents are on the later stages of their lives. They're like, I don't even know what they had. Mm-hmm. They won't talk about it. And I said, well, it's going to be a nice surprise for you one way.
Because you can't tell them.
Yeah. And because nobody wants to talk about these things. And so I really appreciate you and Autumn and everyone helping us to actually have those conversations. And then we'll get to, how we prepare our kids for it and the beneficiaries. And that's a really important point. How do you prepare your heirs for the wealth they get?
Yep.
Not just preparing our wealth for them.
There's a lot, Tom, about transferring and avoiding taxes and avoiding probate and avoiding those kinds of things, but very little about receiving. And so I think that's one of the strengths of doing a solid plan is that the people are prepared. So because you and I both work in a team approach, and so we're very committed to working with the client's advisors around the different disciplines, that gives you a lot better chance to do that if somebody's going to run into that conversation. So, and it's usually accidental in my experience, but then it kind of goes around the team that they built, and then they become more intentional, as what I've found over time. So, but I think the client family that you described, that's pretty normal. The younger people get, the more open they tend to be, has been my experience with what we have and amounts of money and those kinds of things. But you don't have to. So for that kind of greatest generation, they were very closed, in my experience, with details about finances. And they usually had a lot more money than anybody dreamed that they did. They were hardworking, a very hardworking generation, and they built things. And so we finally were able to convince them we can train people on how to process things without them knowing how much is there, just that these are the steps in transferring assets. And those meetings they were good with. The values has always been a challenge. And so there was a lot of research and a lot of maybe 15 to 20 years ago, a big thrust on affluenza, the impact of money hurting the beneficiaries. But this was very high net worth. And for me and you, people that work with, I never have figured out what to say, regular people, if that's okay, not these, really ultra high net worth. It hurt us because they assume, well, I don't have a big enough estate. I've learned that rich means more than I have. So if they, I have every client says, what do you do with your rich clients? These people have substantial estates. And so most of the people that we work with in the older generation have a lot of assets. And in the younger, if we're able to do what they need to do, which is ensure against them not having time to build that estate, and they have a family to protect, then they need insurance. And that insurance is their estate. And so they don't have cash spending money, but they've got a large estate on my side. Mm-hmm. So if you are able to show them how much you really need in a two-income couple, a young client family has a large estate too for death planning, less so for life planning, which of course is where you focus. And so help them build it and then they become the older. So the estate planning, the age really is not the determining factor. It's how much you care about the family being positioned correctly if something happens. And so that affluenza is not really helpful because it distances people from what needs to be done with just a good size, what people would consider a regular income.
Right.
This 30% that do plans, it's the top 5% or so that get most of the attention. And I would say 4.8 of that 5% are regular people. And then all the articles are about the top, 1/10 or 2/10. And all the tax fairness stuff is about billionaires and stuff like that. Well, that doesn't affect us, we think, but it does because we think we don't have to do anything. So it goes back to your first question. That's one thing that people fall asleep at the wheel on because, I don't have that big thing. So values, things like work ethic and integrity and the whole host of things that you would list out are important. And when people inherit money, they can get challenged. But most people, we had a client that said, I got most of my inheritance while my parents were living. Just at their death, I just got a check. And so that was nice, but the real inheritance was the values.
Yeah, that's tremendous. Yeah, and I take that to heart. There's a lot of focus, obviously, mitigating taxes and, the wealth transfer. And I'm sure as things wear on, that's even get bigger with so many people retiring and our generation and our population getting older. But, when I talk to obviously younger clients and say they have a decent income, I said, the value of you, this goes back to human life value, life insurance, and you're worth millions because the value you bring daily through your jobs, your businesses, if something happens to you, your family doesn't get that. And so that really strikes a chord more recently because I think that people recognize their mortality and they're like, wow, my family wouldn't, have the resources to live the life I want for them. And it's really driving to think broader about it. But just like life insurance, a lot of people are thinking it's just around death, but you and I know how valuable it could be to help you build wealth and live, right? Use that policy in life. And I think estate planning has a similar angle to it. So can you share more about maybe why it's so important for estate planning, while you're living, not just for the transfer of wealth and values?
Yeah, there's a couple of things. And then I want to touch on the overlap between the two also, because the great odds are, and everyone listening here knows that you do the family banking type of approach, and that's a minority approach. And the way that I do it with the long-term transactional, anti-transactional relationship based is their minority views, but the people that embrace it really love it. It makes a lot of sense for everyone. So the quickest thing is, I'm going to quote a wise person who just said it, which was talking about doing the hard things now. You can get an estate plan and have it be easier the earlier you start. So when I think I don't have a lot of assets, the assets, remember, have to be titled. So we didn't do a real educational part to this, but just so everybody knows, if you do a trust, everything you own has to be owned by or payable to the trust. And that stack of papers then controls whatever is owned by it or payable to it. When I say payable, that's like a beneficiary designation on life insurance or a 401k or an IRA. And then everything that you put together will work. But when you start out, you may not have a large net worth, but you've got typically that strong income is a good client for both of us. And it matches up. The people are working hard and usually spending more than they want to. They're trying to get through everything. But if they use the family bank, they get some double duty from their dollars. And so that makes a lot of sense. And what's interesting on our side, the fact that you own fewer numbers of assets means that big project we talk about is easier. Mm-hmm. And it's easier to pull it together when you're young with fewer and then just add to it through this maintenance over life. So I think that's one of the big things that's a benefit. Another is you've got a lot of time to do education. And so just going over things repetitively, it's so overwhelming, Tom. You know this, and everybody trying to be on his side. He's supposed to explain everything about insurance, which is ridiculously foreign to everyone. And then he's also got to say, and then there's this estate tax and all these other things. It's just so overwhelming to the typical person, and it's a flaw in the way that the professions have grown up. And so you can't absorb it all. It needs to be something that, how to eat an elephant one bite at a time. So the repetition equals retention, and it does get easier. So the earlier you start during your lifetime, the better it will be. And the more chance the people who are the beneficiaries can see what's going on. I find, Tom, that the easier plans at the end, and they come from actually pretty bad circumstances. So if a client has been disabled before they die, the family members were forced to rally around them and do the long-term care things and help out with bill paying and all sorts of different things. And when that type of client dies, the family was already kind of in motion and used to the fact that they do it. And those are our cleanest and easiest settlements. So if you have a will, it's a probate. With a trust, you settled it up without a court. So they call them trust settlements. Those are the ones that work the best. And so just living life and learning as you go makes a big difference. And I did want to, during our time, mention this to you, the direct overlap between what we do. Life insurance, and if you've worked with Tom, you know this, but I meet with people every week, Tom, that don't. Life insurance is taxable, and now that I have everybody's attention, for death tax purposes, and I'm an estate plan attorney, so when I talk about tax, everybody goes straight to death tax. When Tom or any financial advisor talks about tax, you think instantly of income tax. So properly handled, life insurance is income tax free. And so that's whether you're doing the family banking, you should not generate a tax at any point, properly done. And then on death, when the proceeds come in, it's not added into the beneficiary's income. But the death benefit amount is taxable for estate tax purpose. And so historically, what lawyers recommend is to pursue vehicles that take that property out of the death taxable estate. And the problem with that is you can't use it during your lifetime. And so we have really interesting conversations because the people that Tom works with are looking at insurance with that double meaning. And in fact, probably even more so to build that safety net and to have access to liquidity when they need it and kind of a forced savings plan. It's great. And so as you do that during lifetime, those people will bristle immediately when I say, well, you have to take this policy and put it outside your estate and you can't use it. So those types of attorneys don't work in prosperity economics or with family banking. And so there are some vehicles for married couples where we can get a best of both worlds. But for the most part, you just have to watch the size of your estate includes that insurance. And again, that's why I say if you're a young parent and you do some number crunching with Tom to replace the income, and so many are now, Tom, two income couples with sizable income, then they live to that standard of living. And the housing's ridiculous in many areas of the country. And so mortgages are huge. They've got to have both incomes. So if one dies, and I'll put this in quotes, young, they had to have a huge amount of death benefit to create an investment pot that would throw off that income. And so when you look at a husband and wife, 2-income breadwinner, that is a large estate because of the death benefit on the insurance. And so it's a challenge for us because we want to be sure that you can do everything that you're talking with them about to access the cash value, borrow against the cash value, those kinds of things. And you can only do that if it's either personally owned or you get some special legal tools. The name of it, don't want to hide the ball, it's called a spousal lifetime access trust. That's not the normal vehicle that an attorney would come up with. And it does not work with single people. But especially young married couples, it's something, one more time, Tom, you can learn that the trust doesn't get in the way. Everything is owned by the trust, and you need a little time to have it experience that it doesn't, it seems like a big overwhelming thing, but pretty soon it becomes invisible and you just operate out of it. And just like a lot of people operate out of their family banking policies, originally that was very foreign. The more you do it,
Yeah.
the more natural it is. And so I think those are some of the things during lifetime, that keeping in mind the access that you need, and then getting the plan in shape and learning over time. I think those are the big advantages for estate planning.
Yeah, and you're right. I mean, it's funny. The retention, and it hits home certainly for me. Obviously, I live and breathe, life insurance, investments, and but every time I go through with you or all of them around an estate plan, I learn something more, or it gets stickier.
Yeah.
Right. It takes some time, but to your point, my goal of that is, personally, is that when I do pass, things are set up and it's easier for my family.
Yep.
And they get to keep more of the wealth, and they understand it, and it's not, hopefully they'll be sad.
Something we stumbled on, Tom, and that you've heard, but and it's just when you see people a lot, and we bring people back in groups, and so it's more of a presentation to review what happened this year in the law and those kinds of things than a one-on-one conference can do. And so there's, you got to keep it fresh and interesting and that kind of thing. And about 10 years ago, maybe 8 years ago, somewhere in that area, I stumbled on a phrase that you just used, which is that what are the top reasons why people do an estate plan? And at the very top, I haven't got any clients that don't have it in the top 3, is to make things easier for those that come after you. So we've developed this little routine that every time we get together, how many of you have as your top goal, or maybe one of your top 2 or 3, that you're doing all this work because the grumbling has started here. They had to come to a meeting and do that. And so you're putting out a lot of effort on behalf of your family, and they don't know it or appreciate it in many cases. And so how many of you are doing all this because you want to make things easier for those that come after you? Show of hands, and every hand goes up. So when you die, somebody calls the office, and the hard part to get across to people is it's not you making that phone call. Everybody laughs, I found it helpful. Picture in your mind that there's supposed to be a speech that comes out of the other end of the phone, which is what you want to hear. You correct me if I'm off. Everything is in good order. And that is so relaxing. And it's a joke now, a running joke in our practice. And so even at death, we get a surviving spouse calls in, and I say, I know this is a really rough time and a terrible time, but I do have at least a little sliver of good news for you. And that is that everything is in good order. And that means something to them. And so we found that motivated people, Tom, to do all that owned by and payable to the trust, because I asked them, give me the speech if you've got 19 assets and 17 of them are in place and we don't know about the other 2. So what's that speech? Everything's in pretty good order, or, it's just not the same thing, or everything's in good order except for these 2. I mean, they jump right through the phone. What 2? So that's why you do it. And we actually keep score during lifetime of here's how many assets you have. And everybody, Tom knows this, but that little report that you get, the asset review report, has a counter on the end, and it says out of 13 assets, 11 of them are verified. So it's not just that the client has done the work, but they actually show the law firm the paperwork. And sometimes we're able to do the paperwork for them, but it's usually a cooperative effort. Like you have to do your own bank account. You have to physically show up at the bank because of the Patriot Act. So there's some things we can do, but it's very much a joint project between the firm and the client family working together. And so we keep score, and this is my season to do those meetings, Tom, and we are at 91%, and I've got another meeting coming in. We say, how many assets? So I can tell everybody the totals. I can't obviously tell somebody Tom's business or the next person's business, but we gather them all up and say, here's how many assets are owned in this room. Here's how many we have the verification paperwork for. And we've been doing that for about a decade. So the clients are very competitive. They want the 100%. Of course, my job's 100% of 100%. And that's just very difficult. So tracking like that, which very few people do, we're still only at, I'm going to say only at 91%. That's really, really good. So perspective wise, I know it is, but the second little scorecard was out of so many families, how many had 100%? And you'll find that drops and it's around 45 or 55% because so many have one missing asset. And so that give you a flavor of how we work during lifetime. It's like, so let's work on that one asset. If you're looking at your thing, you got one thing to do, let's do it. And everybody laughs, especially if they're married, to ask you to do one thing.
Well, that's right. That's why my wife always tells me, stop acquiring more assets. Other direction. It's like cleaning out of your garage. Like
it is.
Don't add anymore. But one of the last things I wanted to chat, and you touched on a little bit too, and I guess it's a moving target too. You mentioned the estate estate taxes, right? The death tax, and that can be a moving target, right? Based on what our friends at the government want to do. But I would expect there are, given the boost in asset prices all across the board, and we're seeing some corrections here and there, but more people will get ensnared in that potentially, that it could be a costly thing for people. I mean, so I guess, like, how is your approach with that? With a lot of people who feel like they're not going to get hit by this, but who knows, right?
Yeah. I think you'd be surprised by the answer. You draft the document so that it doesn't have numbers in it. It has concepts. And so if an estate becomes an estate size, you create an extra trust that defers the tax. And the vast majority of people, this answer will probably surprise you, Tom, is that I start out by telling them it's true that you don't have that problem, but we don't know long term. And so I'm not going to guarantee what the Congress will do. Does that sound like a good idea to you, to count on what the Congress is going to give us? And no one says, yeah, that's great. So we put a formula in the document, and so you're covered by having it. And then in these annual meetings, we'll walk through, this is what the number is this year, and this is what's up in the Congress. So right now, the vast, vast, vast majority of people will not have a death tax problem at the federal level. There are a number of states that have an inheritance tax, and that's your magic number for death tax. So what's interesting, though, is while we protect against death taxes, because these exemptions got to be so large, especially in the Trump years, it actually started under Obama. And that's not fair. It actually started under Bush. And under the Bush administration, we actually repealed the estate tax for 1 year. And it exposed something I want to share with everybody. And then it came back into force because of a sunset, which means you had to pass it again, or it's as if it never happened. We're living under a sinking sun right now that goes away at the end of 2025, and the number will go down automatically. So Congress has to affirmatively do something. But still, that number's large enough that most people won't get caught. The ones I'm concerned about in Tom's client base, everybody, is the ones that are properly insured, again, because of that death benefit. So that's what we have to watch. But the thing that people don't realize is if an asset is not included in your estate, which is a good thing, no death tax, it doesn't receive a basis adjustment on death for capital gains. So we have kind of a kitchen sink trust. Tom knows this, and we teach all by stories, but that trust is designed to give us the maximum capital gains relief without causing a death tax. And so it's a kitchen sink. We throw everything in. Trusts do a number of great things for people that we haven't touched on. Lifetime problems if you're a beneficiary, creditors, divorces, so it's not divided in a divorce. Long-term care expenses are out of hand already and probably going to get worse. So our inheritors, when somebody else creates a trust for you, you can set it up so that is usable by you. But if later there's a problem, we can adjust it so that Medicaid can't force it out, a creditor can't force it out, things like that. And so doing those kinds of trusts, that's the good side. The bad side is trusts can pay higher income taxes if you don't know how to use them. If you do know how to use them, And so, Tom, I found that provocative statements work better. So we'll sound like a jerk here, but this is the way it is if your advisors know what they're doing, you will never pay more with a trust than without it. Never pay more income tax. And it's possible, if there's any difference, that you'll pay less. But handled correctly by people that know what they're doing, it'll never pay more. So take that off the table. Well, everybody, what Tom is trained and all financial advisors are, trust pay higher taxes. So the key is, don't have the trust pay the taxes and still work through all these benefits. And that's doable. And that's why people have to learn. And that's your lifetime work. And it's just a lot of complexity. And so we tell people, okay, we're going to send you back to law school. The good news is it took me 3 years, and then I started learning. So for you, you get, 20 minutes at a time. And here's really what you need to know. It's all broken down. And for the right client, they like it a lot.
No, that's great. And, this is, going back to something you said before, this is why it's so great to be able to work with experts like you to help collaborate and help clients, because there's so much complexity and depth to it, and it's never always staying the same anyway. So it's so important to have these sort of periodic check-ins and sort of evaluating people's situations, because it's never going to stay stagnant. And, unfortunately, I think there are a lot of people who are running across where they set an estate plan 10 years ago and haven't looked at it.
That's right.
Anybody. And of course, we know their lives have changed, and for some of them dramatically. So it's really a good point to really sort of emphasize. People need to stay on top of it, just like they're staying on top of their health, their wealth. It's so important. So at some point, I'd love to have you come back too, to maybe talk a little bit more details around trusts and stuff like that, because I know there's a lot of misinformation or misunderstandings around them, and be important to you. But this was a great introduction to this, and if anything else, it's hopefully a wake up call for folks to at least evaluate this for your own benefit, to get started early, just like anything else. Life insurance, your finances, getting started early and continually learning is so key, and it'll make it easier along the way, and certainly for your families when you eventually depart. So, Rick, thanks for your time. Appreciate it. And how best folks reach out to you? Website, what's best to reach out to you?
Probably the best is email is probably the best. And it's Rick R for Randall, Rick R at NNEPA.com. That's National Network of Estate Planning Attorneys.com. And our website is NEPA.com, but there's less out there. The members like to explain it rather than just throw things at you. So I think if you email rickr at NEPA.com, that's probably the easiest way. And I'll either hook you up with somebody in the group or talk with you through our firm, whichever you prefer.
Awesome. Wonderful. Well, Rick, and I appreciate your time, and I look forward to continue work with you guys, and appreciate all your help and the wisdom we shared today. So thanks a lot.
Thanks for having me. Come back anytime.
Thanks for joining me on this episode today. I really am grateful for you as listeners to the Perennial Pride podcast. I hope you're getting some tremendous value out of it, and hopefully pushing you along your journey to financial freedom. I put this podcast together really to help you get more educated around your finances, so that you feel empowered to live the life that you really want. And if you like the content that you heard today or watched, then I would encourage you to go to my website, perennialpride.com. There's tons of other content there. And you can access my book, Wealth Beyond the Numbers. You can buy it there on my website. It's a aggregation of a lot of great tips and tools I've learned to not only build my wealth in my accounts, but build wealth in my life, and abundance and joy, and something that has a lot of my experiences in the journey that I've been on personally. Hopefully that can be also of value to you as you sort of move forward. So thanks again for being a Perennial Pride listener, and we'll see you on the next episode.